Alright friends, so please write the heading concept of EOQ. EOQ stands for economic order quantity. So as I said, EOQ stands for economic order quantity. So let me explain you what exactly is this EOQ. When a firm which is continuously purchasing its material, it is stuck up with one particular decision, as in how much quantity of material it should purchase at a time. Because if you purchase too big quantity, you will have to carry that inventory. If you purchase too small quantity, then you will have to place too many orders for buying the material. So what should be the optimum quantity? That optimum quantity is basically referred to as EOQ, or economic order quantity. Now I'm sure you would have learned this concept at cost and management accounting already, and therefore you are not interested in me speaking it up, and you may not like it, but I will just ask you to have a little bit of patience, because this concept is directly connected to Baumol's model, and for that I need one thing, that your fundamental clarity with the concept of EOQ should be established. So please carefully listen to me. When you place orders for procurement of material, you generally have two types of cost that you incur. One is classified as ordering cost, that is the cost of placing an order. Another is classified as carrying cost, that is cost of carrying the inventory. So the point is, ordering cost is dependent on the number of orders you place in a year. So the cost of placing an order is fixed for each order. If you place more number of orders, proportionately you will be incurring more and more amount of ordering cost. On the other side, if you are purchasing material in some defined quantity, that much quantity you will have to carry until the material is fully consumed. So you will have to carry that quantity, and that carrying of inventory requires some cost to be incurred, that is carrying cost. So the fundamental point is, ordering cost and carrying cost are two such components of cost which are inversely related to each other. So if you try to minimize the ordering cost, the only way to minimize the ordering cost is to place less number of orders. That means you buy bigger quantity in one each order, and you place less number of orders in a year. For example, if you want to buy 6 lakhs units in a year, you place just 6 orders of 1 lakh quantity at a time, and you will just have to incur 6 times that ordering cost. But you know what will be the wrong impact of that? You will have to purchase 1 lakh units at a time, and carrying that inventory with you will cause you to incur lots of carrying costs, and your carrying cost will shoot up. The only way to minimize your carrying cost is to place order for smaller quantities, and when you try to place smaller quantity order at a time, the number of orders will increase, and which will shoot up your ordering cost. So I am sure you are trying to understand that these two components of costs are inversely related to each other. You try to minimize one, the other one would shoot up. You try to minimize the second one, the first one would shoot up. Our objective is not to minimize any individual component of cost. Our objective is to minimize the overall cost, and the optimum order quantity which can minimize the overall cost is known as economic order quantity. Whatever I am going to explain to you as a concept, I will have to take examples, and let me show you an example over here. With this example, I would want you to carefully understand the whole concept. Let us look into how to write up the solution for the same. We are supposed to determine economic order quantity, in short EOQ. So EOQ is defined as square root of 2 times A into O divided by C. Let us define these variables. So EOQ stands for economic order quantity, A stands for annual requirement, which in our example is given as 36,000 units, O is the cost of placing an order which is given as rupees 7,500, and C is carrying cost per unit per annum which is given as rupees 15. When we apply all these calculations in the formula, we get 2 into 36,000 into 7,500 divided by 15, and this whole thing is under square root. So when you apply this calculation, what you get is exactly 6,000 units. Let me tell you what exactly I want from you. So calculation of EOQ using this kind of formula. Once you learn formula, you can do this calculation n number of times. It takes hardly 2 minutes to solve a question. But the point is how good you are with the concept, not just with the formula. The question is, can you determine EOQ without using this formula? If you can determine EOQ without using this formula, then only you know the concept of EOQ. If you are dependent on this formula, means you do not know the concept of EOQ. So what I'll do is, I'll just help you out with something over here. Initially, please avoid writing. I'll give you enough time to note down things later, but first please try to understand something. I am making a table. And I will plot the number of orders randomly as one order. When I say one order, it will be throughout the year a single order I'll be placing, and all the inventories required I'll be purchasing through single order. Then I go for 2 orders in a year, 3 orders in a year, 4 orders in a year, likewise 5, 6, 8, 9, 10 and 12. So I have randomly picked these number of orders. So after 5 I did mention 6, I am avoiding 7 and I will directly go for 8, then 9, then 10. I am avoiding 11 and just picking 12. This you could have done by taking any number of orders. This is just a random selection. However, when you are taking one order, what you need to understand is all your requirements you have to purchase through this one order itself. Your annual requirement is 36,000 units. So if you are placing a single order, your order quantity per order has to be 36,000 units. If you are placing 2 orders in a year, your order quantity has to be 18,000 units. If you are placing 3 orders in the year, your order quantity has to be 12,000 units per order. If it is 4 orders, it should be 9,000. 5 orders, it should be 7,200. Do you know, the combination of these two is made in such a way that number of orders multiplied by order quantity per order should be matching with your annual requirement. And this is how you plot different possibilities. Now what we need to do is, we have to find the total annual cost of placing the orders, that is called ordering cost. We have to find the total annual cost with respect to carrying of inventory, and then we take the aggregate of these two. Let us first figure out the ordering cost. So ordering cost will simply be number of orders multiplied by ordering cost per order, and that will be one order multiplied by 7,500. It will give you 7,500. Then 2 orders multiplied by 7,500 will give you 15,000. 3 orders multiplied by 7,500 will give you 22,500. 4 orders multiplied by 7,500 will give you 30,000, and so on. For all the number of orders, we have multiplied these by 7,500 and we got total annual ordering cost. So the next point that we need to understand is how to determine this carrying cost. And in order to understand how to determine the carrying cost, you should first fundamentally understand one thing, that you have purchased in this first order 36,000 units. Throughout the year, if you carry 1 unit, I repeat, throughout the year if you carry 1 unit, you will spend rupees 15. Throughout the year if you carry 2 units, you will spend 15 into 2. Many students, what they do is they multiply 36,000 into 15 and they get answer as 5,40,000, which is incorrect. because 36,000 units you are not carrying throughout the year. These 36,000 units you have purchased for consumption, and by end of the year the quantity of this inventory will come down to 0. By end of the year the quantity of this inventory will come down to 0. So your average inventory will be 36,000 plus 0 divided by 2. I repeat, 36,000 plus 0 divided by 2. Because you are buying only what you require, end inventory will always be 0. So your average inventory will be half of the quantity ordered. Average inventory will be half of the quantity ordered, and half of the quantity ordered will be 36,000 divided by 2, that is 18,000 units. And when you multiply 18,000 to rupees 15 per unit, you will be getting 2,70,000 as your total annual carrying cost. So that way, if you go to the second line, in the second line you are placing order for 18,000 units at a time. So your order quantity is 18,000. Average inventory will be half of 18,000. So take half of 18,000, that is 9,000, and to that you multiply 15, and you will be getting 1,35,000 as your total annual carrying cost in the second line. Likewise, let us try to figure out each and every calculation in this carrying cost column, and then what we do, we take the aggregate of all these. When you take aggregate of all these, your objective is to minimize the overall cost over here. Now what is to be understood over here? Please carefully observe this column, the last column. That is the column of total cost, the total cost column. If you observe over here, our objective is to minimize the total cost, right? Our objective is to minimize the total cost. So what we should aim at? We should aim at the lowest figure in this column, and that is this amount, 90,000. There is no amount lower than 90,000. This is the lowest amount of total cost. So let me highlight this 90,000 as the lowest amount in the total cost column, and this lowest cost is happening at what quantity per order? Look at the corresponding order quantity. It is happening at 6,000. I hope you are able to understand that the lowest cost is what we are targeting at, and it is happening at the quantity of 6,000. So we declare that this 6,000 quantity should be considered as economic order quantity, and that will require you to place 6 orders in a year, because the total quantity that we require during the year is 36,000. That is our annual requirement. To fetch that annual requirement, we must have order quantity per order as 6,000, and number of orders placed during the year should be 6 orders. Another very important thing, observe the nature of ordering cost and carrying cost. With the increase in the number of orders, what is happening? The corresponding order quantity per order is reducing. So both of these are inversely related to each other, and dependent on that, if the number of orders are increasing, the ordering cost is also increasing in that same proportion, but the carrying cost starts reducing. That means if you plot these two components of ordering cost and carrying cost, if you plot these on the graph, you know, with the increase in number of orders, the ordering cost goes on increasing. It will give you an upward movement, and the carrying cost is declining. It will give you a downward movement. The point at which these two curves, that is the ordering cost curve and carrying cost curve, would intersect, that will be the point of equilibrium. And notice one thing, the point of intersection will be the point where the cost exactly matches, and that is this level, that is 45,000 and 45,000. Look at all other components, everywhere else the cost has a mismatch. You know one thing, by simple theory of equilibrium, where there are two factors that are inversely related to each other, they will be having the lowest total, lowest aggregate when they are at par. That means they are intersecting on a graph, and that will indicate the point of equilibrium. So we are aiming at finding an order quantity. I repeat, we are aiming at finding an order quantity at which the total ordering cost for the year should match with the total carrying cost for the year. Now with this characteristic of equilibrium, let me take you ahead and show you something very, very important. Now I'll give you enough time to write down, but as of now what I want you carefully understand this point, something very, very important. Q is a variable that we have considered. So Q is supposed to be order quantity. I repeat, Q is the order quantity. A is the annual requirement. Now Q, when I say as order quantity, I am not emphasizing that Q should be economic order quantity. It could be any order quantity. Okay. A stands for annual requirement, O stands for cost of placing an order, and C stands for carrying cost per unit per annum. I told you I'll give you enough time to note down this. As of now, concentrate on what I'm showing on screen. Now, do you know what is going to happen? With this information, if I ask you to find the total number of orders during the year, how many orders would you place in a year? What you would do? Tell me what you would do. You would pick the annual requirement, correct? Which in our example is 36,000, and suppose order quantity is 9,000. So what will happen? 36,000 units you are going to order during the year, and at a time you are placing order for 9,000 units. So the number of orders that you would get, I repeat, the number of orders that you would get will be 4 orders. 36,000 divided by 9,000. Suppose you are placing order of 3,000 units at a time. So your order quantity becomes 3,000. Annual requirement remains 36,000. What would be the number of orders? The number of orders obviously will be 12 orders. Now, I am trying to find out total number of orders per annum, and that will be A divided by Q. Guys, can we agree that total number of orders per annum logically will be A by Q? Thereafter, what is the total annual ordering cost? What is the total annual ordering cost? How do you find total annual ordering cost? Number of orders should be multiplied to cost of placing a single order. That means A by Q should be multiplied to O. So I will write that equation as total annual ordering cost will be A by Q into O. Now do you recollect how do we calculate total annual carrying cost? How do we calculate total annual carrying cost? We calculate total annual carrying cost by dividing the order quantity by 2. I repeat, by dividing the order quantity by 2, we get the average inventory, and order quantity divided by 2, that should be multiplied with this component C, that is carrying cost per unit per annum. So we get Q by 2 into C as your total annual carrying cost. So tell me one thing over here. For equilibrium, what did we learn some time back? That total annual ordering cost should match with total annual carrying cost. If we can do that, if we can equate these two, do you know what will happen? What will happen if you can equate these two? The order quantity that you have assumed as Q will actually become economic order quantity. Currently, Q is standing for any order quantity, but I am writing a line if Q has to be EOQ. If Q has to be EOQ, I repeat, if Q has to be EOQ, total annual ordering cost should be matching with total annual carrying cost because of the targeted equilibrium, and that means A into O by Q equals to Q into C by 2, because this is the total annual ordering cost, this is the total annual carrying cost. If you equate these two, you will find that Q will become EOQ. Now if you are just trying to solve this equation, cross multiply, and this 2 gets multiplied to A into O, and this C over here becomes the denominator over here, and this Q gets multiplied to this Q, and it would eventually become Q squared. So what do we get? 2AO divided by C will become Q squared. What will be the approach to find the value of Q? If Q squared value is this, Q value will be square root of 2AO divided by C, and that Q is basically EOQ. This is how you obtain economic order quantity formula. Let us move ahead and now talk about concept of OCB. Just like EOQ, it is concept of OCB. OCB stands for optimum cash balance. Please write this heading, optimum cash balance. That is concept of OCB, optimum cash balance. Now once you have written this heading, that is concept of OCB, let me take you to question number 7, which is given as 7th question in your cash management segment. So please observe the cash management part of your notes. That is that segment of working capital management where you find cash management given. Initially we have solved 6 questions. Now look into this 7th question, which is William J. Baumol's model, or simply Baumol's model of determining optimum cash balance. Look at this question. It is exactly following the EOQ style of calculation. It says a firm maintains a separate account for cash disbursement. So there is a firm that is maintaining a separate account for cash disbursement. Total disbursement are rupees 1,05,000 per month or rupees 12,60,000 per year. So basically the firm wants to make a total payment of 12,60,000 every year. An administrative and transaction cost of transferring cash to disbursement account is rupees 20 per transfer. So because you want to make frequent payments, you will have to keep that cash arranged. So assume that you have a main bank account from which you will be making transfers to this disbursement account. Every time you make a transfer, there is a fee chargeable, that is rupees 20 per transfer. Just like how we compute that as ordering cost per order. Correct? Ordering cost per order. It is of that type. Now marketable securities yield 8% per annum. So what is the significance of this line? Marketable securities yield is 8% per annum. If your money is lying in your investment bank account, that means a bank account which is generating yield for you, or if that bank account or if that investment is providing you an yield of 8% per annum, the moment you transfer the money from that investment to your disbursement account, you stop earning this. Correct? You stop earning this 8%. So when you stop earning, it is as good as an opportunity cost for you. So for every 1 rupee, I repeat, for every 1 rupee, what will be your opportunity cost during the year? For every 1 rupee, what will be your opportunity cost per year? It will be 8% of that 1 rupee, that is 8 paisa, or we can say rupee 0.08. So logically that becomes a cost of carrying 1 rupee for 1 year. If you are carrying that 1 rupee for 1 year in that disbursement account, you are sacrificing an opportunity of rupee 0.08 per annum. As a result, considering all this, we apply the EOQ model concept and we determine the optimum cash balance as per William J. Baumol's model. So OCB equals to square root of 2AO divided by C. Same formula basically, but the meaning of the variables would change a little bit. So we write OCB stands for optimum cash balance, A stands for annual disbursement, which is 12,60,000 informed to us, O is the fixed cost per transaction, which is given as rupees 20, and C is opportunity cost per rupee per annum, and that is rupees 0.08. And how did we get this? As 8% of 1 rupee. When you substitute all these values in the formula, what you get is an amount of rupees 25,100. So if you get some fractional value, you can round it off to rupees 25,100.